I'm Juan Sánchez, a research economist at the Federal Reserve Bank of St. Louis. As part of my job, I'm often asked about financial conditions. We track financial conditions at the Federal Reserve because we expect that as the Fed increases the interest rate, financial conditions tighten. That means it's more difficult for households and firms to access credit. What that means is that then, as a consequence of the tightening financial conditions, this is going to create a slowdown in the economy that firms are going to take into account in the pricing decisions, and as a consequence, the increase in interest rate should help bring down inflation to our target of 2%. How do we track financial conditions? We track financial conditions using standard financial condition indexes developed by different institutions. These indexes are weighted average of different financial variables. For instance, they consider the S&P 500, they consider bond yields of different maturity, they also consider indexes of volatility as the VIX index, for example. These indexes based on financial variables sometimes move as response to news or information that is not necessarily capturing changes in access to credit by firms or households. So with that in mind, our challenge was to create a new index of financial conditions that doesn't use financial variables. So what we did for that, we used an index that was created in the literature that classifies sectors by financial dependence, by how much these sectors depend on access to credit from the financial system for investment and employment decisions. So we classify the sectors of the economy in two groups, the more financial dependent and the less financial dependent. And our index is the difference between the growth of employment of the less financial dependence and the more financial dependence. So when financial conditions are loose, it means when there is credit, we should see that the sectors that depend more on financial conditions grow relatively faster than the other sectors of the economy. In the other case, for instance, during a financial crisis, we should see the sectors that depend more on financial conditions to suffer more. As a consequence, the sector employment will be negative and the index of, or the growth gap index would increase. The first exercise we did after we created our index was to plot it together with standard indexes of financial condition, for instance, with the Bloomberg Financial Condition Index. What we find is that although it doesn't use any financial variable, it can move quite closely with the standard financial conditions indices. So one thing that this says is that the standard financial condition indexes, they are capturing to some extent how firms are accessing credit. The follow-up question was, how are financial conditions today? So what we did here, we're going to compare it with three periods. One is going to compare it with the first quarter of 2022, when the Fed started to tighten monetary policy. So what we see is in both types of indexes is that the Fed policy have also tightened financial market. Financial market to date are clearly tighter than in the first quarter of 2022. Now, the second comparison is with the last 10 years. We think that this is a relevant comparison because this should be informative about how households and firms feel about financial conditions today. And what we find is that also these indexes average during the last 10 years is lower than today, so it means that financial conditions today are tighter than during the last 10 years. Now, the last comparison is with a longer horizon, for example, 20-25 years. So if you compare with that period for both types of indexes, what you find is that financial conditions are close to the average. So with a longer perspective, what we would say is that financial conditions today are not that tight. They are closer to an average of financial conditions. So again, we would expect households and firms to feel today that financial conditions are tighter because they have tightened during the last 2 years. They're tighter than the average of the last 10 years, but financial conditions are close to a longer horizon average. For more information on this or other topic, visit stlouisfed.org.